We've got trader Jud Pyle of PEAK6 Investments standing by live at the Chicago Board Options Exchange. Our featured guest is John Praveen, the Chief Investment Strategist at Prudential Financial. And John, let's kick things off with you. We just heard from John Sullivan saying market valuations seem reasonable, and then that means we should see more gains. Do you agree that valuations are reasonable right now?
Yes, the valuations are reasonable. They are not as cheap as they were in March 2009, but they are not expensive. So valuations are definitely reasonable. But valuations are not the ones that are going to drive the markets. What is going to drive the markets are earnings growth and GDP growth.
Do you feel like we're seeing that earnings and GDP growth?
Yes, the GDP growth is already coming through, and we'll also beginning to see some improvement in earnings, and we should see a lot more improvement in earnings going forward.
All right. So, Jud, let me bring you into this. John sounds very upbeat. I just talked with Joe Lavorgno over Deutsche Bank. He's talking about 6% economic growth. He's very upbeat as well. Where do you guys, where do you sit on all of this?
Well, I think that throughout the course of 2010, I feel like up 10% is going to be kind of the upper range, so 1250 on the S&P and 1,000 to the downside. I think we are range bound, so you're going to have things. Look what happened yesterday. We were up 1%. Today we're back down 1%. So I think they're going to be trading opportunities within this kind of secular bull market. I would agree with the thesis that we have room to head higher. The key to earnings season, as John pointed out, we have to get good results from these stocks in order to justify the valuations, and so far that's what we've seen for the past week.
All right, but what about the factor of everybody unwinding those major stimulus programs? Today you've got stocks selling off on concern China's moves to kind of curb lending are going to slow that global economic recovery. John, let me put that question out to you. People are starting, Chinese officials, there's talk here in the U.S. about starting to put the brakes on all this unprecedented stimulus, and here we've got markets selling off. Isn't that going to kind of somewhat freak out investors?
We are going to see this kind of volatility throughout the year because there are two things that are two opposing forces at work here. One is changing interest rate expectations, what you talked about exit strategies and all of that. And as against that, you have strong GDP growth and strong earnings growth. And that conflict between the tug of war between these two factors, forces, is going to keep market volatility high. But we think that the growth, earnings growth and GDP growth is going to win the day and propel the markets higher.
You know, Jud, it's funny, and I've asked this to several guests. I mean, a year ago, we were all talking about Armageddon. We thought the financial system was coming apart. We thought we could see a Great Depression potentially. I mean, has that much, it certainly feels better, but has that much changed fundamentally in the past year, in your view?
Well, no, I was never in the camp that we were going to have Armageddon. I thought that on a fundamental earnings basis, the S&P was a buy in the fourth quarter of 2008 and clearly the first quarter of 2009. So I'm more of the camp that what we had was a liquidity crisis, and it was a huge global margin call as everybody started to delever. So from your to answer your question in terms of what's really different out there, take a look at the SIBO volatility index. Well, it's significantly lower than where we were, and we're still sub 20 even with a big down day today. So that's indicative of people being willing to put more capital at work, because what's different now than a year ago, uncertainty. The market hates uncertainty, and we've removed a lot of that over the course of the last 9 months.
Well, and maybe some of that overnight as well. And I just think about the elections in Massachusetts, the Republicans getting another seat in the Senate. I mean, Jud, in terms of health care, I mean, a lot off the table at this point in your view then.
Yeah, and I would be a buyer of the HMO stocks. I'd also look at the drug stocks. Obviously, they've had a run, so don't go piling into them thinking you're going to get the quick pop. We could get a little bit of a pullback now that the news is out of the way, but be a selective long-term buyer, because on a valuation basis, UNH, Cigna, we've seen big upside call buying. I think people are looking for these stocks to continue to run over the course of the next couple of months, because at 10 to 11 times earnings, they're too cheap relative to the rest of the market. And as you said, the scepter of Washington is a little bit out of the way here.
All right, let's get back to our guest over the Chicago Board Options Exchange, Jud Pyle of PEAK6 Investments, also still with us, John Praveen of Prudential. Guys, I got to tell you, I got a viewer emailing in, Dean, and he says your guests are very divorced from Main Street. Short-term thinking again. How about some insight about what is happening with the other 75% of the population despite earnings and GDP growth? Brings up a good point. If you're out there on Main Street, don't have a job, still worried about maybe making your house payments, you're in a very different feeling, very different mood. John, that's a good point.
Yes, I can understand what the concerns of the person sending the email, because unemployment is very high. It's over 10%, and it is probably going to take a while in this year before unemployment comes down meaningfully and provides some relief to the common man. So, but then as the economy begins to recover, Main Street as a whole begins to get some kind of a relief, because it's not just jobs, but a lot of people on the Main Street also own stocks and bonds in their retirement accounts and all of that. So if the market is doing well, some of the retirement accounts are doing well, and they should that should also benefit to some degree the Main Street.
So John, to toss it back to you on what we were talking about with the consumer, how delicate do you think the consumer recovery is? Could something like that or another factor easily derail it at this point?
You see, in past recoveries from deep recessions, consumer was the main driver of the recovery. Joe was talking earlier about past recoveries, and that the GDP averaged around 6.5%. Out of that, consumer spending actually contributed about 4% of the recovery. In this particular recovery, we are looking for something like about a 2% contribution from the consumer, because of all the headwinds that the consumer is facing in terms of about high unemployment and some deleveraging from of the consumer. So the weakness in the consumer sector is already priced into the overall GDP numbers.
All right, we're going to have to leave it on that note. Jud, thank you so much. Jud Pyle of PEAK6 Investments. John Praveen speaking right there, the Chief Investment Strategist over at Prudential.